There's a number of properties that are in good markets that are struggling. And we've seen, really a flourishing from a lot of small local property managers who know their market better than anyone else. And some of these, like you said, are markets that have often been overlooked until recently.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
All right, everybody. Welcome to another episode of the Alternative Investor Mastermind. Jack and Zack are here. We're doing an internal episode today. Talk about some headlines in the news here. Recently, Blackstone just agreed to take an apartment income REIT private in a $10 billion deal. And we're just going to chat a bit about what that may mean for the market. So, Zack, thanks for joining us.
Yeah, no, thank you, Jack. This is an exciting one. I mean, this is the biggest move we've seen in multifamily in a long time. We haven't seen anything at this scale, even from Blackstone in quite some time.
Yeah, and it's telling when you have groups like Blackstone that are multi-billion, hundreds and hundreds of millions, or nearly $1 trillion under management. When they make big moves like this, there's no guarantees, but often it means we're kind of at a bottom or at a turning point in the market. I do want to quickly look at this stock price here. If you look at this chart, and this is the REIT that owns apartment buildings, and
this is Air Communities.
Yeah. And those of you who've listened to various episodes, I often talk about how for accredited investors, for those of the higher net worth, REITs are often not the best vehicle because their dividends are actually not tax efficient. The dividends can get taxed at 29.6%. But if you look at the stock price up until January 2022, and for those just listening, I do have a chart up right here. So if you do watch this on YouTube, you should be able to see the chart. The price was in the $54 per share range. And then as interest rates started moving, the price dropped into the 40s, down to 36, and as low as $28 and change in October of this year. And then there was a little spike. And right before the Blackstone deal, the stock was trading at closer to $31 a share, and Blackstone paid 38 plus per share, so more than a 25% premium to buy the REIT and take the company private. So, this is telling. And even though this was a REIT, I think they've had some of the same issues. And we haven't went through every page of their 10K to really do a full analysis of their portfolio, but there have been a lot of headwinds in commercial real estate. Anyone who had bridge loan debt, the rates on the SOFR, which most bridge loans were based on, have went up over 5 percentage points over the past year or so. It was extremely challenging for many investors, both in private multifamily syndications as well as REITs. So, The bad news is, their stock price had cratered close to 50% from the peak. It does match where we've seen some individual properties trade that were distressed. We've seen individual deals where if an owner had to sell right now, they would sell probably 25 to 30% less than where they might have sold, at the peak in 2021. However, most owners with good debt terms are just not going to sell in this market. They're going to wait for interest rates to stabilize or come back down and the market to be more aggressive. But it is telling that Blackstone still paid a 25% premium. So
and Jack, I heard a really great quote from the COO of Blackstone, John Gray, about this acquisition, and I'll read it for you here. So it says, "We are not waiting for the all clear sign and believe the best investments are made during times of uncertainty." I think that really sums up where we are in the market right now. Is multifamily has been hit hard. There is distress out there. There are, some operators who are, again, like you mentioned, whether it's because of variable rate debt, whether it's they're in markets where rents are softening, there is distress in the market. And as Blackstone is showing us here, that usually means there's a pretty good opportunity to buy. There may be some markets that, that aren't rebounding as well as others. But I was taking a look, Jack, at basically the portfolio of communities in this acquisition. They're in strong metros. They're in strong markets. I see, acquisitions right off the bat in Atlanta, throughout, Virginia, throughout Colorado, throughout Florida, North Carolina. There are some really strong properties in great markets here. And I think Blackstone is taking advantage of where we are in the market cycle.
Yeah, that's great. And it actually draws a parallel to some of our own work over the last 6 months. It's been certainly, as we've talked to hundreds of investors, there's a lot of the retail accredited investors, those that are, investing 100, 200,000 into real estate instead of the stock market, are scared right now because they see the negative headlines. However, we've placed an $8 million allocation and a $6.5 million allocation from a private equity fund that we work with that we source deal flow from. So obviously they're nowhere near the size of Blackstone, but another sophisticated group with hundreds of millions of dollars, and they're piling into multifamily right now. So what I keep telling our investor community is that follow along with what the big guys are doing. Now is not the time to turtle up and be scared. Even if you have a few dollars in a deal from 2021 that has some challenges, you should be dollar cost averaging in and over a 5-year period, the deals that we're getting into now, as they mature and cash out, as rates stabilize, even if rates stay where they are, honestly, the deals that pencil now in today's rate environment, with a value add strategy, rates don't need to really move to generate a return.
Yeah, no, I think you're right. And one thing that I really like from this Blackstone acquisition, so it was 76 communities in the portfolio nationwide, and one thing that is really important to add in terms of their strategy is that it's very value add focused, where they're looking at investing another $400 million to improve the communities, to maintain, and even they'll put some additional capital in to fund further growth. So they're really taking a strong value add approach for some of these properties that might have been maybe not neglected, but that haven't been run to their full potential for some reason or another. And a lot of times it is capital constraints for these operators who were not well capitalized.
Yeah, that's a great point. The deals that we've seen that have run into trouble have generally been because they're undercapitalized. A group kind of that clubbed together to raise capital for syndication, that didn't have the wherewithal to raise additional money when needed, through either a capital call or taking on private equity. Those are the deals that tend to be failing. The deals that are, even with debt, that are struggling but making it through, are the deals with sophisticated operators that have a significant amount of capital reserves and that are willing to infuse new capital into the deals. And the banks have largely been working with those groups. There are a few deals that we've had to make capital calls on, and that capital call was made in conjunction with a loan modification. So when we're underwriting these deals and we know we have to put in perhaps 10 or 20% additional investment, it is along with a solid business plan where you know exactly where your debt's going to be for another 2 to 3 years, and that you can track the financials and track the growth of the net operating income from now until where the properties will likely sell in 2 to 3 years. And you can see that the deal makes financial sense, not only for the new money in, but in a way that protects the original money that was invested as well.
Yeah, no, you're 100% right. And that's where, again, especially someone like a Blackstone with so much capital to deploy, they can be quite selective. And, it just shows that the value add component of having a well-capitalized deal where you can also, again, place, more good money into maybe fix up bad deals or deals that were, very much underperforming, it has a lot of potential behind it. And they always, being the large institution they are, they play the long game. They're not buying these for, a 1 year hold and sell in most cases, right? They're looking to make multifamily a much larger part of their strategy, of their portfolio, and see that, the market has hit tough times and they're ready to capitalize, and they're putting a whole lot of money behind it.
Exactly. And Zach, you know what? I've actually seen this movie before. Blackstone owns a company called Invitation Homes. And at the bottom of the residential market, 2010, 2011, they came in and they started buying up tens of thousands of single family homes across the major markets of the U.S. And that actually signaled the bottom of the residential real estate crash. And
right.
it looks like we can't 100% time the market by any means, but I think there's a good chance they're doing it again here. So for those that are trying to time the market or think that they're going to time a residential crash, I don't see that happening. There's still a supply shortage. Blackstone still owns many of those homes. They're now rentals. They're not single family homes. So there's a systemic lack of inventory on single family properties, and 70% of homeowners are locked below 4% interest rate, or actually of those 30 to 40% do not have a mortgage. So residential to me is not going anywhere, and that to some extent will prop up the commercial side of the market. And there are some markets that have a lot of new supply that have hit, but the supply is generally the higher end of the market. You cannot afford to build middle class or workforce housing without a substantial amount of free government money and tax credits. So what many of these communities are, and many of the communities that we focus on, are value add workforce housing where we're buying them below replacement cost. And there is, because of how expensive single family houses have gotten, there is a systemic supply shortage. And if you buy a community that needs a little bit of value add, there's often a waiting list or a lot of tenants that want that high quality workforce housing, something that's been newly renovated and is just higher quality than may be available for those on a budget, on a fixed income, that are not in the market to buy a $500,000 house.
Right. No, and when you look closely at the portfolio here, that Air Communities just sold to Blackstone, I see a lot of really dense, urban metros where there's not necessarily a lot of new supply coming online. And that's one thing that we've mentioned with single family, over the years, is there hasn't been enough supply being built. And we're seeing now, in some of these, again, very dense urban communities, these dense MSAs, that there isn't as much new supply of multifamily coming online either, which means that, this type of play to get into multifamily, the value add is the way to go versus ground up construction, or, there's a lot of talk about conversions, whether it's office to multifamily, hotel to multifamily, senior living to multifamily, whatever it might be. I'm not seeing that in this particular portfolio, and really in the different opportunities that we're looking at internally here at JKAM. We're not looking at areas that have a lot of new build supply coming online over the next several years.
Yeah, that's a great majority of our markets, and even the markets that do have some supply. I was recently in Phoenix for a convention, and actually took a bus tour to view a few properties with operator that's heavily invested in Phoenix, and even a market like Phoenix that does have a fair amount of supply. All that supply is at the $2,500 a month rent point, whereas most workforce housing and value adds at $1,500 a month. So maybe a few tenants go upstream, but I think it's largely two separate markets. And even if it shows supply, it's not really a competition for the types of properties that we're investing in. And then even those markets that did have supply coming, the permits have plummeted. Anything coming now was started 3 years ago when interest rates were a few points lower, and often before all of the supply chain and inflation and the higher cost of materials. So what you've seen is, anything that started is now coming on the market now, but we're unlikely to see hardly any new supply, at least a significant new supply in the next 2 or 3 years, because there's no new permits right now. So fast forward 2 or 3 years, when we look to likely sell some of the investments we're investing in now, Best case scenario is rates are stabilized or dropped slightly, and there's no new inventory out there. So there's a chance that the deals that we're invested in right now, I mean, these could be some of the best returns we've seen since 2010 to 2012.
I think you're right. No, and that's exactly what we talk about on a daily basis. It's what we're excited about. It has been a tough market, but seeing this type of acquisition at such a large scale, seeing some of the deals that are now available out there, it's not like anything we've seen over, what would you say, Jack? Maybe the last year and a half, maybe even 2 years.
Yeah, it's been incredible, and look, real estate was really on a 15+ year bull run. So I'd argue that some of the deals now are probably about as good as 2010, 2012, because after 2012, real estate was sort of slow and steady. And then obviously we had a big run up in 2020 and 2021 when rates dropped and housing really just came into focus. People really just rethought where they live, how they live. With the pandemic, it opened up a lot of secondary markets for people to work remote. So it was a boom for both single family and residential. I actually spoke at a real estate club that I got started in 20 years plus ago in Rochester. And Rochester had been a market that really barely moved for many years, and all of a sudden housing prices went up significantly. All of a sudden people that probably were from Rochester and moved down to New York City, had to be there to commute to the office, could now work remote. So housing prices jumped significantly in a market that had barely moved. And we've seen that across our portfolio, and it's even even greater on markets that already had positive population growth. The Southeast and Sun Belt, there's more jobs there, more people are moving there anyway, and that was really put on steroids with post-COVID and with the ability for more people to work remotely. I don't think offices are going away completely, but a higher percentage of people have more flexibility than ever.
Yeah, I think you're right. And one thing that we haven't really touched on much, I think this is also a pretty positive move for a lot of the smaller, local regional property management companies, where we have seen some of the large nationwide operators struggle, basically because, like you said, we've been on a 15-year bull run. And some of these property management companies, the larger ones, are spread too thin. They've had too much new inventory when it comes to what they're managing. And when you look at the renovation schedules and maintenance schedules that some of them haven't been able to maintain, that's why there's a number of properties that are in good markets that are struggling. And we've seen, really a flourishing from a lot of small local property managers who know their market better than anyone else. And some of these, like you said, are markets that have often been overlooked until recently.
Yeah, great. And that's a probably a good time to even clarify how we've generally operated. We're not the day-to-day operator or manager that's going to swing the hammer on these properties. We're on the capital side and we're partners in these deals, but we have 10 to 15 amazing operators with great track records that we've invested with, and they're all looking at hundreds of deals per year. They may buy 2. So rather than us try to look at hundreds of deals and compete with the best in class in market, we're there so that when our partners find that 1 or 2 deals a year, we're part of the team that co-invests and works together with them to get these deals funded and closed. So I think we're the best positioned in the market, because not only are we seeing thousands of deals indirectly because we have great partners reviewing them ahead of time, we're getting sent maybe 20 deals a year and we might do 10 to 12. So we're in that 0.5% of all the deals that are being reviewed. We're probably investing in 0.5% of them.
Yeah, no, I think we're in a good place. It's good to be able to follow along, these large allocators and operators like Blackstone, and really be able to move along with the trend without, again, being forced to deploy into bad deals or into markets that fit a very, very tight criteria. We have that ability to be open and flexible and go where the market moves.
Absolutely. I know that I've seen plenty of groups get in trouble because they have so much overhead and so much infrastructure that they have to feed the beast.
Yeah.
And I've always wanted to avoid that. And that's the way things are structured here. Our diversified fund has minimal to no cash drag because we only take in money when we know we can deploy it. and our other vehicle opportunities come available, and if people want to invest in an individual deal, when the deals become available, we jump in and we reach out to our investor network. When there's nothing available, we sit and wait. So pretty excited about the next 6 to 12 months, even though there's definitely been some pain for some, and out of the 40 plus deals we're in, we have a few that we're working together with groups to overcome some challenges, but largely, our deals are stable, and more importantly, everything we've seen in the last 3 to 6 months has been a slam dunk home run, and I'm really excited about the pipeline of opportunities for the rest of 2024.
Absolutely. Jack, I'd say that's a pretty good place to wrap up. What do you think?
I think so as well. Thanks everyone for listening. Please remember to like and subscribe. We're on YouTube, we're on iTunes, we're on Spotify. We have a Facebook group that is getting more and more engagement. So join our Facebook group for our Alternative Investor Mastermind, and connect with us on all major social media. We're going to be doing more live events as well, where we talk about a timely topic and go live. And those are interactive as well. So please stay connected with us, and we look forward to seeing you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.